What if I told you that US dollar to Japanese yen is setting up for a move that could either print 160 in the next 48 hours or get smashed by a sudden intervention notice, and the final trigger is sitting less than 15 pips from where we trade right now? This is Alpha Market Meridian. The pair is at 158.91, poised right below the critical 159.03 resistance, and the broader market is feeding it rocket fuel. But there is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end because I'm giving out 3 exact entry and exit levels you can use now, and the second one is the play most traders will miss. Here is the instant market verdict. The session bias is strongly trending up. The daily candle is painting itself as a strong buy continuation, and the 5-hour structure confirms that same momentum. However, this is not a blind chase. I'm treating 158.73 as the invalidation line for the intraday bullish structure. Write this number down. If we break below 158.73 today, the whole shift structure, and we likely see a fast liquidation down to 156.68. That is your pivot between trend continuation and a sharp fade. Right now, the weight of evidence supports the long side, but we respect that line. Let's go into the technical deep dive because this is where the real edge is built. I'm going to walk you down from the weekly canvas all the way to the 60-minute chart, and I promise you, the alignment you're about to weekly chart, price is comfortably above the 20-week moving average, which sits at 154.80, above the 60-week at 150.20, and miles above the 200-week at 143.10. All 3 are sloping higher, and there is not a single bearish crossover in sight. This is the definition of a trending market. When the weekly chart is this clean, you do not fight it. You flow with it. Drop down to the daily chart, and it gets even more precise. The 20-day moving average is at 157.50, the 60-day at 155.20, and the 200-day at 150.10. Price has been riding above the 20-day for 11 consecutive sessions. Every minor dip gets bought, and the moving averages are fanning out, which tells you momentum is not just present, it's accelerating. The MACD on the daily is firmly in positive territory, with the signal line expanding away from a histogram. No bearish divergence yet. However, I want you to put a mental note right here. If price pushes above 159.13 and the daily MACD histogram does not make a higher high, that would be the first crack in momentum. We are not there yet, but that will be our early warning. Now, the 4-hour chart is where the tension is building. The 20-period moving average on the 4-hour is at 158.40, the 60 at 157.80, and the 200 at 156.95. Price is above all of them, and the 20 just crossed above the 67 candles ago, a fresh bullish signal. The 200 is acting like a brick wall of support underneath. The MA thinning. That is not a sell signal. It's a pause alert. It tells me buyers are catching their breath before the next thrust. If the 4-hour MACD rolls over and turns negative while price is still near 159, that would be a textbook negative divergence and a trap. For now, the trend is your friend, but we are watching on the 60-minute chart. The granular picture confirms the immediate level field. The 20-hour moving average is at 158.75, the 60-hour at 158.30, and the 200-hour at 157.60. Price is oscillating just above that 20-hour line. The last 3 hourly candles have printed a tight consolidation between 158.75 and 158.95. This is a compression coil, and coils resolve explosively. The 60-minute MACD has a slight bearish lean on the signal line, but it is above the zero line, so it's just a shallow pullback in an uptrend. I am watching 158.73 as the line in the sand. That level corresponds to today's key support and also the near-term 20-hour moving average. A break below that and the 60-hour at 158.30 becomes the next test. Now, let's bridge this technical alignment with the cross-asset narrative because that is what separates amateurs from professionals. The Nikkei 225 and US dollar to Japanese yen are joined at the hip. When risk appetite surges, the Nikkei rallies and the yen weakens, pushing US dollar to Japanese yen higher. Overnight, the Nikkei futures pressed up against 39,000 and held, confirming risk on sentiment. As long as Nikkei 225 stays above 38,000, we see Nikkei suddenly reverse and drop through 38,500. I would take that as an early warning that the risk bid is fading and yen strength could suddenly re-emerge. So keep a Nikkei chart open. It will often tip its hand before US dollar to Japanese yen does. Now the fundamental driver and cross-linkage. The core news in the last 24 hours is a Goldman Sachs note stating that a broader energy shock may pressure Europe and lift the dollar. This isn't just an observation, it's a catalyst. Energy shocks push inflation expectations higher, which props up US Treasury yields, and that widens the US-Japan yield differential. Right now, the 10-year Treasury yield is holding above 4.5%. While the Japanese 10-year government bond is capped near 1.05% by the Bank of Japan's yield curve control framework and dovish stance. That spread is a massive carry trade magnet. As long as that gap stays wide, the yen will remain under structural selling pressure. Today's energy headline added another layer of dollar demand right when the technicals were already coiled, and here comes the drama. At 158.91, we are well into the intervention scare zone. The Ministry of Finance started verbal jawboning heavily when US dollar to Japanese yen approached 158 back in April, and actual intervention happened around 160 in the past. The ghost is real. I'm not saying the BOJ will step in today, but I am saying that the risk of sudden, massive two-way price gaps increases exponentially above 159 is up. The fundamentals support it, but the tail risk of a 200 pip smash in 5 minutes is priced into the anxiety. That is exactly why we use firm invalidation levels and tight stops, now the 1 to 2 week directional lean. I remain bullish on US dollar to Japanese yen as long as the daily close stays above 157.50, the 20-day moving average. The path of least resistance points to a test of 160, possibly 161.50 if the energy story continues and US data stays firm. The exact event that would invalidate this thesis is a weekly close back below 156.68. That's the deeper support you see in the key levels. If that happens, it would signal a meaningful sentiment shift and a potential intervention aftermath. Until then, the trend is not broken. Most people will skip this next section, but this is where money is made. Keep watching. I'm giving you 3 trade setups with exact triggers, stops, and reward logic. I'll start with the sniper, move to the active trader, and then the aggressor for those who thrive on chaos. Strategy 1, the sniper, conservative. You wait for a confirmed breakout above 159.13 on the hourly close with strong bullish volume. That is your trigger condition. Do not chase the initial spike, let it pop through, and then wait for a successful retest of the 159.13 level turning into support. Once a bullish pin bar or engulfing candle forms on the 15-minute chart right at that retest, you enter long. Your entry will be at 159.15. Stop loss, intraday support and the 20-hour moving average, giving a 30 pip risk. Target 1 is 159.80 for a 65 pip move. That's a risk reward of roughly 1 to 2.2. Target 2 is 160.50, the psychological round number, for 135 pips, risk reward 1 to 4.5. Move your stop to break even once 159.80 is hit. This setup is void if we fail to hold the 159.13 retest and instead fall back below 158.90, because that would be a false breakout trap, and you want no part of it. Strategy 2, the active trader, standard. Here you're anticipating a pullback in the strong trend, not a breakout. Wait for a move down to the 158.75 area, which is the 20-hour moving average and the first key support. Your entry condition is a bullish reversal candle on the 15-minute time frame at that zone, with a low wick showing rejection. Enter at 158.78. Stop loss goes at 158.50, which is below the 60-hour moving average, and that 28 pip stop respects the noise. Target 1 is 159.10, just below the immediate resistance, for 32 pips. Risk reward 1 to 1.14. Not spectacular, but high probability. Once target 1 hits, trail your stop to entry. Target 2 is 159.50, 472 pips. Risk reward 1 to 2.6. The trailing stop rule after target 1. Move your stop to 158.95, locking in some profit. This strategy leans on the mean reversion of a trending market, and the logic is that as long as 158.73 holds, the structure remains intact, so a bounce from that zone. A JPY closing price for tomorrow in the comments right now. I'm reading them, and I'll highlight the most accurate range in tomorrow's video. Strategy 3, the Aggressor, high risk. This is a counter-trend fade for those who want to play the intervention ghost. The idea: you sell short at 159.00, using a tight stop at 159.18, risking 18 pips. The trigger is a sudden spike and stall at the 159.03 resistance with a bearish engulfing or shooting star on the 5-minute chart, and crucially, you want to see a simultaneous Nikkei 225 turn lower. That cross-asset confirmation is your edge. Target 1 is 158.75. The 20-hour MA, 425 pips, risk reward about 1 to 1.4. Target 2 is 158.50. The active trader stop area, for 50 pips, risk reward 1 to 2.8. This is a fade against a powerful trend, so if the price rips through 159.13 without hesitation, you are out immediately. Only for those who know how to lose small and manage risk aggressively. This is not for the faint-hearted. Risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact US news or unexpected BOJ announcements. Stops are non-negotiable. Now, the one most critical level for the next session is 159.13. A clear 1-hour close above that, and we are almost certainly heading to 160. A rejection there, especially if paired with Nikkei weakness, opens the door for a quick 100 pip drop. That's your decision zone. Tomorrow, index sits at a make or break pivot. That video is live now. Check the end screen. If this analysis gave you a clear plan, smash like, subscribe, and hit the bell for daily coverage across all 8 assets. I'll see you in the next